People love whole life insurance. Many people think life insurance is for when you die, and it is, but you can also use the life benefits of whole life insurance while you're still alive. What about term insurance, though? Is it any good, or is it a waste of money?
Well, term insurance is the way I started buying insurance back in my 20s. But when I turned 45, I desperately wish I would have also purchased whole life insurance. You see, term insurance is good for a temporary purpose. And when it's gone, that term is up, well, it's gone.
Term insurance is not a waste of money in its proper place. In fact, it can even be considered better than whole life insurance for accomplishing a specific purpose. But many people who have term now are going to be severely disappointed when that term is up because you can't roll back the clock and buy insurance at the low rate you had before.
So, when people think about the proper place for life insurance, they're typically thinking income replacement or leaving a legacy. And those are some of the things that life insurance can be used for. There are some other things that we can use life insurance for as well. We could use it for a buy-sell agreement to fund a business. So if one partner dies and is out of the business all of a sudden, what's the other partner going to do? They need some money to replace that partner and what that partner contributed to the business. Maybe even they need some money to buy out the family of that other partner. So life insurance can be a great tool there as well.
It can. There's different types of insurance that can provide that need. So we can go through all those types of insurance. There's term insurance, like we're going to be talking about today. There's whole life insurance. There's other types of insurance like indexed universal life and variable universal life and traditional universal life. But what is the proper place for term insurance? That's what we're going to talk about today.
And you mentioned that you wish that you would have bought whole life insurance as well as the term insurance you bought. Why is that?
Well, when I was 20, the premiums on a whole life policy would have been so much lower. And those low premiums would be the same premiums I paid for the rest of my life because in a whole life product, the premium is guaranteed never to go up. Whereas the term product, when I turned 45, it was expired. And guess what? Now, if I wanted it, I was going to have to pay a much, much higher premium to keep that term insurance going. If I would have started that whole life policy back when I was in my 20s, I probably wouldn't even have needed the term insurance when I was 45.
So that brings us back to you wished you had bought the term insurance like you did,
Absolutely.
but also the whole life. So why would you want both? If you've got the whole life, why would you need the term?
Well, I think a good example of that is I was just talking to a 64-year-old lady the other day that when she was 44, they told her, you don't need to buy whole life insurance, just buy term and invest the difference. Well, she's 64 now, her term expires in another month, and she says, I need life insurance that's going to last the rest of my life. But now she's between a rock and a hard place because the premiums on her whole life have gone way up.
Or on
And
her term?
on her whole life too, because she
Oh,
could have bought
okay.
whole life
Oh,
at
sure.
44
Oh,
at a
okay.
very low price. And now she's 64. She's got to pay a lot more for that. So she cannot get all the coverage she needs or desires with the amount of money that she can pay in premium.
Is it still worth it for her to get some whole life insurance?
Absolutely.
Okay.
So she's
because
going
a
to,
lot of people might think, I'm too old at this point. I just missed the boat. But that's good that you can still get some.
so she's going to dedicate part of her budget to buying whole life. And then she's going to augment the death benefit with term insurance that is convertible term insurance, which we're going to talk about later, so that she has the option to even increase her permanent insurance before it becomes too late for her altogether.
So how should somebody that's looking to split their budget between whole life insurance and term insurance, how should they look at those numbers?
Well, let's go back to this 10-20-70 principle that we always do from the richest man in Babylon. 10% of everything we make should be something that we keep. And there's no better place to keep that than in participating in whole life insurance because of the strong guarantees and the participation that you have with the insurance company.
So there's the number right there, 10%.
Now, term insurance is to replace your lifestyle or the lifestyle of the people that you love. So that should be coming out of the premium for that should be coming out of your 70%. It should be budgeted just like your taxes, your mortgage payment, your car payment, your food and groceries. It's replacing the income that you would have generated for your loved ones so that the family lifestyle can continue to go, or your loved ones aren't hurt, or your business partner, or whoever you're buying the term for.
So that 10% that you're using to buy the whole life insurance, you're buying an asset with that is appreciating in value. When you're purchasing the term insurance, it's only for a set period of time. It's going to run out. So it's kind of like buying your food. I mean, you buy your groceries, but at the end of the week, guess what? You got to go back to the store because that was a perishable product. So same thing with the term insurance. It's just purchasing something necessary for a time period.
So term insurance is like renting,
Very much
or even
so.
like renting a house. Only, with term insurance, your rent is going to be going up significantly over your lifetime.
Exactly. And let's just look at an example. I was talking to a client yesterday that bought whole life about 10 years ago.
Okay.
And he now has more cash value in his life insurance policy than what he paid for the policies. And that's going to continue to happen because every year now, when he pays his premium, his cash value increases as if he got a 75% return on his premium dollars.
That's excellent.
And each year after that, it's guaranteed to get better. Now, we didn't even look at the dividends on this policy. We're just looking at the guarantees. With a term insurance policy, after 10 years, he would have just been out the money that he paid for that. And the premium will just start rising, and there is no return. There is no living benefits in a term life insurance policy.
So let's talk about an example of how we might take these numbers and split it down into a real life situation. If we have a 35-year-old guy in great health and he's making $100,000 a year, well, 10% is $10,000 a year. So he could put $10,000 a year toward a whole life insurance policy. But that whole life insurance policy, if it's designed for high cash value, it's only going to buy him about $250,000 of death benefit in the first year. And let's say he needs $1.25 million of life insurance. Well, he can get the other $1 million in term insurance, and he's only going to pay $820 a year. It comes out to just over $70 a month for that coverage, that term insurance coverage, which will come out of his 70% budget. So now he has all the insurance coverage that he needs to provide for his family, the protection, all of that. But now let's look at the numbers over time. If he had bought all of this insurance in term insurance only, let's say he just bought the $1 million term policy, then 8 years down the road, he's going to be out over $6,000. 11 years out, he's going to be out over $9,000. If he keeps it for 30 years, he's going to be out over $24,000 on that term insurance policy. That's money he's never getting back. But since he bought the whole life insurance as well, now 8 years into this policy, the whole life insurance policy, the whole life insurance, he has everything back in cash value, what he paid in premium for that policy.
So if he surrendered that policy, it really cost him nothing at that point.
And that's on the projected values. It's year 11 if we look at the guaranteed values on that policy. So
That's awesome.
He got the money back that he paid for his insurance. And if we go ahead and add the term insurance premium to that, then it just takes him a little bit longer to recover the premium of that based on the way that the whole life insurance policy grows.
So the whole life recovers both the money he paid for the whole life and the term?
And for the
after
term.
a certain period of time.
Exactly. So it's after year 10 on the projected values that the whole life recovers both the cost of its premium and the cost of the term premium that he's paying because he split the two. Now, let's fast forward 30 years down the road. The death benefit on his whole life insurance policy is probably $500,000-$600,000.
Oh, because it's grown that much.
It didn't stay at $250,000
Because it's
been
participating
growing.
in the profits of the company.
Exactly. Now, when his term insurance, if he still needs, $1.25 million of term insurance, he doesn't have to buy as much term.
Yes.
Oh, sure.
By the time he gets out to 65. If he had to buy all $1 million of term and keep that going just for another 10 years, when he's 65 years old, he's going to have to pay over $4,000 a year for that.
Ooh.
And he's
a big
never
difference.
getting any of that money back.
Yeah.
Okay.
Yeah.
Now, if he really pays attention to this concept and sees how well the whole life insurance got started for him, on this first whole life insurance policy, the premium is going to drop down after 7 years. He should buy another policy at that point, because if he gets multiple whole life policies going, then he may not even need term insurance by the time he gets to 65. He might have the $1 million plus all in whole life insurance death benefit by that time.
So there's a concept that's floating around and it's become fairly popular where the insurance company is seeing that, oh, people need that term insurance beyond the whole life needs. And they've gone to what's called 90-10 policies
Yeah.
designed for a whole life, where they're blending term insurance inside a whole life policy instead of keeping them separate
Yeah.
like we do.
So that
That-
instead of buying a whole life and a term, they're just buying one
Yeah,
whole
they're-
life and term
Put
kind
it
of
all together.
They're putting
Okay.
the term into the whole life as a rider, as an attachment to it. So now it's contingent upon the whole life policy to have even the term.
So is that a good thing?
Well, in certain situations, it can be beneficial, but
Very limited. Yeah.
very limited, especially if you're going to want to access and manage your cash values. And John, you cut a video about that just recently that explains the logistics behind that and shows the pros and the cons.
We'll link to that video. It's on the McPhee Insurance YouTube channel. It's on 90-10 policies, and you can see why those are not usually the best option. Get your whole life insurance and term insurance separately. You have a lot more options on how you control the future.
So we've talked about the purpose of life insurance is primarily for the replacing income if someone dies, but it can be used for other purposes. Term insurance can be used for a buy-sell agreement to fund it to start off with a business. It can also be used to allow a bank to give you a loan, knowing that if you die, the loan will be paid off. That's not really true collateral. It's a collateral assignment, but it's not really true collateral because there's no cash value in a term life insurance policy. So it can be used to augment whole life. It can be used blended in with a whole life as a term rider. And it's also used as the very basis, the coverage of universal policies, whether they're indexed, traditional, or variable.
During the break, Stephen is going to talk more about index universal life insurance policies. And after the break, we're going to talk about convertible term insurance. Convertible term changes the game. We'll be back right after this.
Indexed universal life insurance is classified as permanent insurance, which is confusing because it behaves more like term insurance. That's actually what it's built on. I'm Stephen McPhee with McPhee Insurance. The appeal of IUL is that you can get protection of life insurance and the returns of the market all in one product. IUL is not actually invested in the market. It has a cash account which mirrors an index. To protect the cash account from a poorly performing index, IULs have a floor rate, which guarantees the minimum return on the cash account to usually be no less than zero. However, they also have a cap rate, which sets a limit on the amount the cash account can return. It is concerning that the cap rate is not guaranteed. The insurance company is allowed to change it. Dividends earned on an index will not be mirrored in the policy. The return on an index with and without a dividend can be substantial. That's the investment element of IUL. The protection element of IUL, the death benefit, is provided by term insurance, which, while cheap initially, becomes expensive over time. So expensive, in fact, it often destroys the cash value of the policy. Fees are a problem as well. Of all the types of life insurance, IULs have among the most fees, and that gets expensive. Some people buy IUL because they want to get protection and investment all in the same product. Some people buy IUL because they are greedy. They want it to make them rich. And some people don't want IUL, but they end up getting it because they don't realize what they've been sold. Life insurance contracts, IUL contracts in particular, can be lengthy and hard to understand. This is my brother up in a scissor lift. The 4 columns of paper on the right, that's all one IUL contract. That's over 85 feet of IUL contract. If you have life insurance or are considering purchasing a policy, you owe it to yourself and your family to thoroughly read and understand the policy. At McPhee Insurance, we sell and review life insurance. If you want an independent life insurance review of a policy you already own or are considering purchasing, we can help you. It's well worth the $75 to have financial peace of mind. Contact us 702-660-7000 or by email team@mcpheeinsurance.com.
Well, as Stephen just explained, indexed universal life isn't something you can depend on because it uses a temporary product, term insurance, for the coverage. There is a way to use temporary product to provide permanent coverage, and that's where convertible term comes in.
convertible term insurance, it sounds like it might have some extra features, and it does.
It does.
It has an extended feature. Sometimes conversion is available on a standalone term policy for a limited amount of time, but the rider typically allows the policy to be converted to permanent insurance that insurance company sells during more of that level term period.
And what that means is you get approved for the term policy. Let's say you got a preferred health. And so you can keep that term policy as long as the term is 10, 15, 20 years. But along the way, if you say, hey, I've got some money that I can start contributing towards a whole life policy, you can convert part of your term insurance to a whole life policy with high cash value without even going through underwriting. And you get to convert it at the preferred rate. So this has been really useful for clients who have purchased a convertible term policy and then they decide to apply for a whole life anyway. And then the insurance company said, oh, no, we're going to decline you. Or no, maybe you've got a health issue now that your policy is now going to be rated. That happened to us before. Guy had standard rating. He applied for a whole life policy and they said, oh, no. Now you're going to be Table D. And Table D means he's going to pay a lot more for his insurance than what he would have at the standard rate. So he just said, no, never mind. Let's forget that application. I'm going to go convert some of my term insurance. And the term is at standard rate. So now the whole life is at standard rate.
Excellent.
You have to use the current age, but the rating is the same.
It's saving health, but not saving age.
That's
when the
right.
conversion happens.
That's right. And it's kind of insurance to guarantee that you can buy whole life insurance in the future, no matter what your health.
So when I was 52, I bought convertible term insurance because I knew that in my future, I would probably want to buy another whole life insurance policy. And at age 52, things start happening in a lot of people's lives that might have prevented me from buying whole life insurance at my preferred health status. So I locked in my preferred health status by buying that convertible term, and I can convert that up until the age of 70 anytime I want to. All I have to do is come up with the money to pay for the whole life.
Now, when you convert insurance, you don't get everything that you convert in the term into the whole life right away, do you?
No, you don't. And you don't have to convert the entire term policy either. So if you have $1 million term policy, you don't have to come up with the premium for a whole life of equal value.
Okay.
You can say, hey, this is the amount that I can afford to put in whole life, and we'll design a whole life and convert part of that term. So part of the term gets converted to whole life, and the remaining term remains as term insurance. And of course, the premium is reduced to reflect the amount of coverage it's providing.
Okay.
Yeah.
So, and someone can do multiple conversions. So maybe they have a term policy that's goes 20 years. They can do multiple conversions along the way.
That could be nice because not only do you not have to come up with the premium all at once, but then as the annual premiums continue, you get to spread those out throughout the year if you wanted to.
Exactly.
It's a beautiful concept for younger people that are healthy to lock in their health so that any time in the future during their term, whether it's 10, 15, 20, or 30 years, they're going to be able to have the right to say, I want whole life insurance, and the insurance company has to sell it to them.
So let's say that I buy whole life insurance and I buy term insurance, which I do. I have both. And let's say that I want more whole life insurance 5 years from now and I'm still in good health. I don't have to convert my term insurance, do I? If I want to increase my insurance coverage and just add another whole life insurance policy, can you explain how that works?
Yeah. So if you have whole life, you have term, and you have money that you want to purchase the whole life, but you'd kind of like to leave your term in place because you also want to up your coverage.
Yeah, which will happen, as my income goes up, as I start a family, things like that. I'll want more insurance coverage.
Exactly. So then you can go in and apply for another whole life insurance. And, your health hasn't changed, so probably you'll still get the same great rate. But if something bad happened and you don't get that great rate, or you don't get a rate that you approve of, even if it's slightly less, then you can always convert that extra that term insurance. It doesn't give you additional coverage, but at least it gives you coverage at a rate that you can afford to pay.
So I have options.
And this
I
has
can
happened
choose.
with a lot of our clients. We'll say, well, let's compare the rates and what we'll put you through underwriting right now because we might be able to find a different rate because insurance rates go down and have gone down over the last 50 years. And so we always want to make sure no one's paying more for their insurance than they need to. Okay. But like you said, Michelle, if there's something that they get rated for in that underwriting, we'll just go back to the conversion because we know we can lock that in at the rate they had or the health they had when they bought the term. My term insurance that's convertible, I've never converted any of it because I've maintained my health and I was able to buy a whole life policy without conversion. And it makes no sense to convert that because I'm paying such a low price for that insurance and it's there for my family if something should happen. So I'm going to buy the whole life and not even touch the conversion.
Yeah.
So we recently had a gentleman, he's in his mid-30s, he's a young father, and he was buying whole life, and the amount of whole life he could afford wasn't providing him enough death benefit. And so I said, well, why don't we also get the term? It's convertible. He doesn't want to just throw his money away. He's a real estate investor and he's very careful with his money because he's trying to create passive income for his family. He didn't want to just throw his money away with term.
Sure.
So when I explained about this can be convertible term, it will allow you to cover your family adequately right now and you also lock in your health. He was able to get a $500,000 term policy for less than $1 a day.
Oh,
And that was a no-brainer.
And that's convertible. That's wonderful because now he just doesn't have to be worried that he's throwing this money away. He has a way to recover it when he converts that insurance. But at the same time, if he builds other whole life insurance in the meantime that never needs to convert that term insurance, he doesn't have to convert it. He's not locked into converting it. It's just his option.
Yes, that's true. You're not required to convert
Right.
it. It's just an option.
Yeah.
Here's another way that convertible term insurance is so handy. A lot of people that we talk to are in so much debt that the payments on their debt doesn't allow them to put anything away in a keep container. They don't have a cash cushion. They can't create a cash cushion because their creditors are sucking everything out of them every month. But now we help them budget with the 10-20-70, and from their 70%, they pay for a convertible term policy, which allows them to get their debt under control. And then once their debt is under control, they can transfer what they were paying their creditors to the conversion of that term to permanent insurance.
And so many people that we start helping too, they have enough 10% income to purchase a whole life on one spouse.
Yes.
Mhm.
But the other one needs coverage and they realize that. And so they'll use convertible term. So the one spouse with the whole life and one with a convertible term, or maybe one spouse
Great
with
way
whole
to
life
start.
and a convertible term and the other spouse with a convertible term.
And when we're looking at debt, having coverage is so important because if something happens to you, you don't want to leave that debt to a single parent or a single spouse. It's and so getting someone started at, like we said, with a temporary product for a permanent solution is an awesome thing, and that's what convertible term does for us.
Picture yourself at a dinner party and you've ordered water to drink. Then you hear somebody else ask for iced tea. Maybe you didn't know iced tea was an option, or you just realize you would prefer iced tea over the water. So you change your request to iced tea instead of water. We like to talk about the different types of life insurance so you know what your options are.
So maybe you're listening to this podcast and you say, I don't really want convertible term insurance. But now you have the knowledge base to help a friend, a son, a daughter. Maybe they're starting a business. Maybe they just got married. Maybe they have a child. There's all kinds of reasons to need life insurance. And now you can help them get what they need for pennies on the dollars and get them on the road to a permanent solution which they can convert to later on in life, all because of you helping them.
Next week, we talk about how to use life insurance as collateral right here on Wealth Talks.